While we watch most commodities fall, China's struggling with the rising price of coal after flooding in Australia depleted supplies. Nera Chehich reports.
It's the world's largest consumer of coal, but China may have to start cutting back. Inventories have dropped to an 11-month low. One analyst says some power plants have as little as 9 days' supply.
In the second quarter, there's a big risk that China may running out of coal because of the low inventory at the port and at power plants. So we think at the same time the demand is very strong.
China relies on coal for more than 70% of its electricity, and coal prices are at their highest since 2008. That, combined with the fact that electricity needs are outpacing coal production, means power shortages are likely to increase. The floods in Queensland, Australia caused a fall in global coal supply, reducing China's sources from abroad. Now the country's low reserves may prompt a rebound in imports. That could increase prices at home in the short term.
We'll be looking to Australia and Indonesia, which have been traditional supply sources, in order to meet that increased demand. The result of this is that some Chinese buyers will now be seen to be paying the slightly higher international prices, and that will allow Chinese domestic miners to push through some price rises in that market.
As the country tries to cap energy use, demand for coal may slow in the longer term. But for now, the shortage will only add to China's biggest economic worry, inflation. Nera Chehich, Bloomberg.
Welcome, Andre.
Thank you, Chris.
Andre, in the second half of 2010, we saw many more positive rating actions in the mining sector than in the steels. What was the reason for that?
Well, you're quite right. We clearly see some divergence in the credit quality between mining sector and the steel sector. The key reason for that is that the profitability in the mining sector have rebounded quicker and stronger than in the steel sector. And behind that, we see a number of structural shifts in the industry which make mining more profitable at the current point. First of all, we see substantial demand from Chinese economy that drives the seaborne trade and consequently prices for most base metals and bulk commodities. At the same time, we still see relatively sluggish demand in the key markets for the European steel makers, such as Europe, first of all, and to a lesser extent maybe US. That's why we have seen quite healthy price levels already in the middle of 2010 for major miners, and we see their margins are roughly 30–40%, which is quite healthy and enables them to generate very good cash flows and to start deleveraging and improve financial metrics, which they did in 2010. At the same time, for the steel industry, we see the margins which are, of course, above what we've seen in the midst of the financial crisis in 2009, but they are still relatively low and do not enable the steel producers to generate sufficient free operating cash flow to reduce debt levels meaningfully.
So steel is more subdued. What do you expect the response of the steel makers to be in this situation?
Well, we expect, first of all, that in 2011 and going forward, there will be a continued shift of the steel-making capacities to the emerging markets. That will be very gradual, but we expect this to continue. For example, we see ThyssenKrupp that ramps up capacities in its newly constructed Brazilian slab plant. We also see that, for example, in case of ArcelorMittal, the capacity utilization in its European operations are usually lower than that in the emerging markets. This is a case for probably the last 12–24 months. We also see emerging markets like China, Russia, Brazil continuing to ramp up production. We think this is a clear trend, and steel capacities, especially liquid steel capacities, will continue to shift to emerging markets. Another thing is, of course, some producers are thinking about integrating into mining. We, for example, see that for ArcelorMittal, world's largest steel maker, this is the key pillar of their strategy. We anticipate that there will be further rationalization measures, some efficiency improvements for the steel producers, although their impact on overall performance will probably be relatively limited, because a lot of efficiency improvement has already been implemented, and so the marginal impact of further improvements probably will be relatively little.
But it sounds that the 2011 outlook for the steel makers and miners, certainly for those huge organisations in the developed economies, are reliant on growth and activity from the emerging markets. Is that fair to conclude? Is that a fair conclusion?
Well, I think it's fair to say that, for example, most mining companies clearly rely from growing demand from China and other emerging markets that drive the prices for base metals and bulk commodities like iron ore, coking coal, nickel, and so forth. If we take European, especially EU-based steel producers, this is only part of the story, because, as I said, we still see a relatively sluggish demand in their key markets. And it's important to understand that for these European steel producers, one of their competitive edges is links with the local car manufacturers, local capital goods producers, their ability to provide the products that those companies need and that emerging market producers cannot necessarily provide. So with the sluggish demand in the European market, it won't be necessarily fully compensated by stronger demand in China and other emerging markets.
Yes. Yeah, okay. Thank you, Andrei. I think that concludes our Credit Matters TV segment today. Again, thank you.
Thank you very much.